Welcome to the November 2024 Monthly Motor Checkup. My name is Dave Lundgren. I am the Chief Market Strategist here at Motor Capital Management Research. The title for this month's video is When Turkeys Fly. Before I jump into that, let's take a quick look at the disclosures. So when turkeys fly. So it's a common misperception that turkeys can't fly. However, they can actually fly for short distances, that is. They do so to evade predators or to reach an elevated roosting spot. It's safe to say, though, that turkeys won't be flying for long distances anytime soon, at least not until they change their body weight and wing structure. It's impossible for them to fly long distances the way they're built. In a similar vein, it's a common misperception that markets crash all of a sudden, when in fact they don't. The market must first undergo meaningful change beneath the surface to allow it to turn a short distance flight, say 5 or 10%, into a more meaningful flight south, say 20% plus, like a bear market. So the difference between a correction and a bear market. So a fun fact is that due to the location of their eyes, turkeys have some of the best vision of all animals and can see danger coming from almost 360 degrees. The motor risk gauge is our 360-degree vision into the surrounding investment landscape, and it warns us of approaching bear markets. And for now, we see no such risk. So this is a picture of the S&P 500, and I think most of us are familiar with it, and we're probably surprised to see it doing this, despite all of the concerns that are mounting with each passing day. This sort of like wall of worry, if you will. It's got a lot of bricks in it, including extreme valuations, record concentration, what inflation path will take place in the future, the economy, the currently very overly bullish sentiment, record flows into equities, including double and triple levered ETFs, Warren Buffett's cash pile, that's always a concern, political uncertainty, of course, geopolitical uncertainty, et cetera, et cetera, et cetera. And our philosophy on all of this is that that entire list is things we worry about, plus more things, and the market's already processed all of that. There's nothing that we worry about that the market's not already focused on, processed, and discounted into the current market environment. And so the idea is that whatever it's doing, it knows all of this, so what's more important is what is it doing despite knowing all this, with the implication being that if it's doing something other than what this wall of worry might imply, there's probably something else going on that the market's focused on that we don't even know about. If you remember, the risk gauge is based on a certain 5 inputs that are inviolable. They're first principle type of inputs that have to be true in order for bull markets to happen, or conversely for bear markets to happen. So in other words, you will never see a bear market that looks like this. It's impossible. That's a first principle. You will never see a bull market that looks like this. That's impossible. That is a first principle. Concepts like that are in this risk gauge. Concepts that are not in this risk gauge are valuation, inflation, bullish sentiment, flows, how much cash Warren Buffett has, political uncertainty, geopolitical uncertainty, all those things, because what we know, obviously, is that they don't necessarily have to result in bear markets. And the flip side of all of these things also don't have to necessarily result in bull markets. So how do we engage with the market knowing that there are things that we just don't know? And my belief is that we can gain an edge in this very uncertain world by just being a better listener than everybody else. And that's what this whole risk gauge has been designed to do. And when I build this risk gauge across 3 time frames, what we see is that the risk gauge is in risk on across all 3 time frames. I can show this to you, and you can see bull market, and you might still say, yeah, I got it, but what about this? Doesn't that just mean that the market's going to do this and your risk gauge doesn't mean anything? So what I want to do is to really just walk you through an example of the risk gauge over time so you can see how it unfolds as the market transitions from bull market to bear market. And I'm building out these slides for every bull and bear market since 1950, and I'll be providing short videos on each of those so you can see how the risk gauge performed in each of those. But for now, I'm just going to show you how the risk gauge performed during the global financial crisis. So this is a big one. And of course, if there's ever a type of environment that we want to avoid, it's certainly going to be something like that. So just to kind of level set everybody, this was the bear market bottom from 2002 to 2003. There's the October 2002 bottom right here. So the internet bubble was up here, and down we went. We know this to be obviously a great one of the great bull markets in history in terms of cyclical bull markets. And we know that this is what it looked like, I should say, as of December 2006, right? So when you look at a chart like this, and you might wonder what might the risk gauge look like? Well, this is what it looked like, and it can't really be that surprising, right? We have risk on in the very long-term trend here, that sort of quarterly time frame. We have risk on in that monthly time frame. Interestingly enough, we have a bit of an internal pullback here. It's still above mixed, but the short term is not quite in risk on, but that happens in the short term. In fact, this can get all the way down here, and as long as these two stay up here, that's just an oversold uptrend. The market as of June 2007, right? So this is the middle of 2007. By this time, we have no idea. The acronym GFC is not even invented. Bear Stearns is still existing. All these real estate loans are still yet to be discovered to be a heaping pile of you know what. So, but this is what the market looks like. And to be fair, there were a lot of people that were very concerned, very bearish at this point in time, but they were also bearish back here when the risk gauges were very bullish, right? Sound familiar? Okay. So if this is the case, what did the risk gauge look like here? Didn't really change too much, but subtly speaking, what we do see here is that we have a new high in the market, yet the risk gauge declined. And this is no longer in risk on. This is still risk on, which means that the long-term trend beneath the surface, one stock at a time, still looks like what you see here. Does that mean that it's a guarantee that the market's going to end up here somewhere before trouble hits? Absolutely not. And I want you to remember that. This positive structure here does not mean at all that the market's going to do this. What it does mean with the structure like this, what this tells us is that you can eliminate just falling out of bed. And that's what this is really intended to help us do. Now, just to give you an example, in August of this year, the risk gauges were all oscillating right around here. And in early August of this year, the S&P dropped, I think it was 8% in about 2 days because the risk gauges were right here. Our response to that was to buy it. The next oversold is a buy. Now, unfortunately, it came as a record volatility spike, which made it very difficult to do. But having this as a backdrop, understanding that this is the structure that underpins the market in that moment of crisis, you want to buy it. Same thing happened during the flash crash a few years ago. Same idea. Most of the risk gauges were up here, happened all of a sudden. What do? You buy it. And that proved to be the right decision. So here we are. Risk gauge is deteriorating a bit, but nonetheless, we have no reason to be running for the hills. As we fast forward to September 2007, so I'm highlighting this to remind you that this is not 2008. This is 2007. The S&P's kind of been going sideways. It's up near its highs. What does the risk gauge tell us about what the turkey sees as it does that 360-degree review of the landscape immediately surrounding? Something quite different, right? So we've got this big drop in the medium term. Remember, this medium term is the equivalent of looking at the monthly chart. So when you see this much deterioration on the monthly time frame, despite this being what the S&P is trying to tell you, you know that there's something going on. And as I always say, at major turning points, the market always lies. It always conceals the truth. It's a shell game. This is the shell that the market's trying to get you to watch, but this is the shell where the nut is. So as we go forward, moving into March 2008, we start to see some actual technical deterioration, right? This is your traditional, I guess you could call it a head and shoulders top, or a double top, or a complex top, whatever you want. The point is, this low has been taken out, so you now have a lower lows. We've already been given warning that this might happen, but how much damage was done during this decline? Quite a bit. Thanks so much for watching this clip of the Monthly MOTR Checkup video. We appreciate your interest in our research, and we hope that you are finding it helpful and informative. If you'd like to continue watching this video, as well as access our most recent Monthly MOTR Checkup, sign up for a free 30-day trial to all of our research at motorcmr.com. You'll find a link to our website in the description below. As always, like and subscribe to be notified of future content.